What if I told you there's a company operating 84 hospitals across 15 countries, from Singapore to Istanbul, that has grown its dividend at 13% per year for 6 consecutive years, sits inside one of the most structurally protected industries on the planet, and yet almost nobody in the Western investment world is talking about it? That company is IHH Healthcare. And in today's deep dive, I'm going to show you everything: the business model, the competitive moats, the numbers, the risks, and whether it belongs in the JC fund portfolio. Let's get into it. IHH Healthcare Berhad, dual listed on Bursa Malaysia and the Singapore Exchange. Ticker IHHMK or IHHSP, depending on which exchange you're using. This is not a small company. We're talking about a $14 plus billion market cap healthcare giant, the largest private hospital operator in Asia by bed count, and arguably the most geographically diversified healthcare business in the world outside of the United States. Our JC Fund framework has screened this as a, quote, pass monitor on Engine A, meaning this is a dividend growth candidate that we're watching closely. Price at analysis, Singapore $2.84. Our fair value estimate, 3 Singapore dollars and 31 cents. Margin of safety, 14.7%. More on all of that later. But first, let's understand exactly what this business does. Here's what we're going to cover today. We'll start with the company overview and how it makes money. In plain English, no jargon. Then we'll map out the competitive moats, because this is the most important part of any business analysis. From there, financials, 6 years of revenue, EBITDA, and margins. Then industry dynamics and regulation, because healthcare is not like other industries. We'll do the valuation, 3 methods blended into one fair value number. Then risks, including a forensic accounting review you don't want to miss. EPS estimates out to 2030, and we'll finish with the investment verdict and the 5 questions I'd ask the CEO if I was sitting across the table from him. So what is IHH? At its core, IHH is a private hospital operator. It owns, operates, and manages hospitals under premium brand names: Gleneagles, Pantai, Prince Court in Malaysia, Parkway in Singapore, and Acibadem in Turkey. Look at those numbers. Approximately 80,000 beds and ambulatory slots, 15-plus countries, 84 hospitals, revenue of RM $22.7 billion in FI 2025, and a dividend per share of 2.52 Sun, which might sound small until you understand it's compounded at 13% per year for 6 years in a row. On the ownership side, this is an interesting structure. Mitsui & Company, the Japanese industrial conglomerate, owns 32.9%. Khazanah Nasional, Malaysia's sovereign wealth fund, owns 25.9%. That gives you 2 incredibly stable, long-horizon anchor shareholders who are not going to panic sell at the first sign of a bad quarter. The remaining 41% is public float across both exchanges. No VIE structure. Clean, dual-listed entity. That's a big deal for governance. So how exactly does IHH make its money? Look at this geographic revenue breakdown. Malaysia, about 30%. Singapore, 28%. Turkey, 27%. India, 11%. Everything else 4%. For very different markets. For very different pricing dynamics. And that diversification is both a strength and a source of complexity that we need to unpack carefully. Now, the revenue model itself. Inpatient services, this is the core. Surgery, ICU stays, overnight ward admissions, billed by procedure code, and bed day. This is the highest margin segment, typically running EBITDA margins of 20 to 25%. Outpatient and specialist clinics. Think walk-in specialist consultations, day surgeries, health screenings. Growing fast. Lower revenue per visit, but increasingly high volume. Diagnostics and pharmacy, lab tests, MRI, CT scans, radiology, dispensary, bundled into patient episodes. High gross margins. And then retail and other, car parks, cafeterias, medical tourism facilitation. Small but annuity-like. The key insight here is that IHH is not just selling hospital beds. It's selling an integrated healthcare experience, from diagnosis to treatment to pharmacy to follow-up, and capturing revenue at every single step of that journey. Let's map out the full supply chain, from upstream inputs all the way to the end patient. Because understanding where a company sits in its supply chain tells you a lot about its pricing power. Upstream, IHH is buying from the pharmaceutical giants, Pfizer, Roche, AstraZeneca, Bayer, medical devices from Siemens Healthineers, GE Healthcare, Philips, consumables from B, Braun, BD, Medtronic. These are IHH's suppliers, and IHH's scale, 84 hospitals, gives a group purchasing power that smaller competitors simply cannot match. Then IHH itself, the operations hub, 36,000 plus clinical staff, proprietary hospital IT systems, group procurement, real estate either owned or long leased. The distribution layer is the brands, Gleneagles, Pantai, Acibadem, combined with insurance panel agreements with AIA, Prudential, Great Eastern. That panel relationship is critical, and we'll come back to it. And at the end of the chain, the patient. Self-pay affluent patients in Turkey and India, insured patients in Singapore and Malaysia, government-subsidized patients through Fortis in India, and international medical tourists flying to Singapore. The beautiful thing here, IHH has pricing power in all four segments. No single payer dominates. No single government controls the entire revenue base. This is my favorite slide in the whole deck. 6 moats, each one meaningful. Together, almost unassailable. Moat 1, brand intangibles. Gleneagles, Parkway, Acibadem. These are 40-plus year trust marks. Doctors prefer to admit patients here. Patients choose based on brand. You cannot replicate a 4-decade brand reputation with capital. Full stop. Moat 2, regulatory barriers. Hospital licenses, specialist certifications, certificate of need laws in Malaysia. Any new entrant faces 3 to 7 years of approvals before they open a single bed. IHH's existing licenses are a structural barrier that cannot be bought overnight. Moat 3, physician stickiness. This is perhaps the most underappreciated moat. The top 20 consultants at Gleneagles Singapore and Pantai Kuala Lumpur generate 5 to 10 times the revenue of an average doctor. IHH retains them through revenue-sharing arrangements, equity participation, and privileged access to the best diagnostic equipment. If a competing hospital wants to poach them, and they try, the switching cost is enormous. Moat 4, network scale. Group purchasing saves 8 to 12% on drugs and devices compared to smaller operators. Shared IT, legal, HR functions. As IHH grows, operating leverage compounds. The bigger it gets, the harder it becomes to compete against. Moat 5, medical tourism flywheel. Parkway hospitals in Singapore are top 10 destinations globally for Asian medical tourism. A patient flies from Indonesia or Vietnam for surgery in Singapore and then follows up at their local Gleneagles when they get home. The network feeds itself. Moat 6, insurance panel power. IHH is a default panel hospital for major regional insurers. Think about the dynamic there. If an insurer removes IHH from their panel, patients will leave that insurer. That gives IHH extraordinary pricing leverage in contract renegotiations. Let's talk numbers. 6 years of financials, FI 2020 to FI 2025. Revenue has grown from RM 13.4 billion in FI 2020 to RM 22.7 billion in FI 2025. That's a compound growth rate of approximately 9% per year. Through a pandemic, through Turkish hyperinflation, through a global interest rate shock, EBITDA grew from RM 3.5 billion to RM 6.6 billion over the same period. And critically, EBITDA margins have held at 28 to 29% consistently. Now here's what I want you to notice in this table. Net debt to EBITDA started at 2.9 times in FI 2020, a touch elevated due to the Fortis and Acibadem acquisition debt, and has improved to 2.48 times by FI 2025. That's a business that is genuinely deleveraging while simultaneously investing in growth. PATMI excluding exceptional items. That's our clean earnings number. Stripping out the MFRS 129 hyperinflation gains from Turkey, which are non-cash and misleading, has grown from roughly RM 0.8 billion to RM 2.4 billion, 3 times over 5 years. And dividends? 1.5 Sun, in FI 2020, 2.52 Sun in FI 2025. That's a 13% compounding dividend growth rate. Engine A investors, this is exactly the kind of dividend trajectory we're looking for. One important note, MFRS 129. This is a Malaysian accounting standard for hyperinflationary economies, and it applies to Acibadem in Turkey. It generates non-cash monetary gains on the income statement that inflate reported profits. Always strip these out when doing your analysis. The real earnings are the exceptional item PATMI numbers. Healthcare is one of the most structurally protected industries in the world. Here's why. On the demand side, Asia's middle class will exceed 2 billion people by 2030. They are demanding private healthcare. The elderly population in Asia is doubling by 2050. Non-communicable diseases, diabetes, oncology, cardiac are surging, and medical insurance penetration is still in early stages across Malaysia, India, and Indonesia. This is not a cyclical demand story. This is a structural, multi-decade demand wave. On the supply side, the constraints are real. India has 1 doctor per 1,400 population. Building a new hospital takes 3 to 5 years and RM 300 to 600 million in capital. Land in Singapore and Central Kuala Lumpur is scarce. Nursing wages are rising 5 to 8% per year post-COVID. This combination, explosive demand, constrained supply, is why IHH can raise prices above inflation year after year. The competitive landscape. In Malaysia is KPJ, the main domestic competitor, but it's government-linked and operates at a lower pricing tier. Bumrungrad in Thailand is a medical tourism competitor. Apollo and Max Healthcare are the Indian peers. But none of them have IHH's multi-geography diversification or brand portfolio. Now let's put IHH in context against its global peers. IHH trades at approximately 32 times trailing PE and 2.8 times EV to sales. Is that cheap? Expensive? You need context. Apollo Hospitals in India, 68 times PE. Max Healthcare, 60 times PE. Bumrungrad, 34 times PE. The peer median PE is approximately 42 times. So on a PE basis, IHH is actually trading at a discount to its Asian healthcare peers, despite being the most diversified, the most scaled, and arguably the highest quality operator in the region. Why the discount? 2 reasons. Turkey uncertainty, MFRS 129, and tri-volatility create noise. And Singapore is viewed as lower growth versus pure-play India stocks like Apollo and Max. The 5-year average return on equity is where IHH looks weaker, around 7.8% versus 15 to 21% for the Indian peers. But this reflects the acquisition-heavy balance sheet and the Turkish drag. As debt comes down and India ramps up, I expect ROE to improve meaningfully through the decade. HCA Healthcare in the U.S., for reference, trades at just 16 times PE on a mature, highly leveraged U.S. business. Different risk profile, different growth runway, not comparable. Here's the valuation. I used 3 methods and blended them together. Method 1, owner earnings DCF, 50% weight. This is the Buffett approach. Net income plus depreciation and amortization plus stock-based comp minus maintenance capex. I modeled 12% growth in owner earnings over 5 years, tapering to 8% in years 6 to 10, with a terminal growth rate of 3.5%, WACC of 8.5%, reflecting the mixed geography risk profile. This gives me a fair value of 3 Singapore dollars and 20 cents. Method 2, EV/EBITDA at 15 times, 30% weight. That's IHH's own historical average multiple, not a peer premium, just where IHH itself has traded through cycles. Applying 15 times to FI 2025 EBITDA of RM 6.6 billion gives a fair value of approximately 3 Singapore dollars and 45 cents. Method 3, EV/EBITDA at 18 times, 20% weight. This is the peer median multiple, which reflects the premium the market awards to Asian private healthcare, 3 Singapore dollars and 60 cents on this basis. Blended 3 Singapore dollars and 31 cents fair value. At 2 Singapore dollars and 84 cents, the margin of safety is 14.7%. Our JC framework requires 30% for a full position. So, pass monitor. It's a quality business. We're watching for a better entry. The reverse DCF is really interesting. If you plug 2 Singapore dollars and 84 cents into model and solve backwards, the market is pricing an approximately 8.5 to 9% owner earnings CAGR indefinitely. That's a reasonable assumption for a business of this quality. The market is not pricing in euphoria here, but it's also not cheap. The magic number to watch, 2 Singapore dollars and 50 cents. At that price, the margin of safety hits 30% and the JC framework clears for a full position. Let me walk you through the earnings estimates to 2030. Base case, revenue grows at approximately 8% per year through FY 2028, tapering to 7% towards 2030. That's driven by organic bed additions. 500 beds in Malaysia, 1,000 new beds through Fortis in India, 300 beds in Turkey. India is the engine of this story. I'm modeling 18 to 20% EBITDA growth from a Fortis and Continental portfolio as integration benefits kick in and occupancy ramps. EBITDA margins stay in the 28 to 30% range. Cost inflation is real, nurses, doctors, energy, but pricing power offsets it. The big wild card is Turkey. I have excluded MFRS 129 hyperinflation gains from the base case. If TRI stabilizes, there's upside. If it deteriorates further, that's downside. The result, PATMI XEI growing from RM 2.4 billion in FI 2025 to RM 3.95 billion by FI 2030. EPS moving from roughly 27 Sun today to 45 Sun by FI 2030. And dividends. If IHH maintains its 13% CAGR, DPS reaches 5 Sun by FI 2030. At 2 Singapore dollars and 84 cents, that would be a 5% yield on today's price by 2030. Not bad for a quality compounder. Now the risks. And I'm going to be direct here. IHH is not a risk-free investment. Highest risk, Turkey. Acibadem contributes 27% of group revenue. The Turkish lira has lost over 80% of its value in the past 5 years. MFRS 129 creates non-cash gains that can inflate reported profits. A sharp TRI devaluation hits RM-translated earnings hard, regardless of how well the underlying hospitals perform. Also high, interest coverage. On an EBIT basis, coverage is approximately 1.9 times. That's below my 3 times threshold. On an EBITDA basis, it's a more comfortable 5.2 times. But EBIT coverage is what matters when debt service comes due. This needs to improve as the company deleverages. Medium risk India integration execution. Fortis is a complex beast. Physician concentration. Top 20 consultants drive disproportionate revenue. Regulatory price controls. Possible but not probable in the near term. Forensic accounting alert Goodwill and intangibles are 60+% of total assets, over RM 18 billion. That is a significant number. Any Goodwill impairment on Acibadem or Fortis would flow straight through the income statement as a large non-cash loss. I also note related party transactions with Mitsui affiliates for rental and services. These are disclosed but worth monitoring closely. Let me show you the JC Fund Engine A scorecard. This is our proprietary checklist for dividend growth stocks. Net debt to EBITDA below 3 times, pass at 2.48 times. FCF payout ratio below 85%, pass at 43.5%. The dividend is very well covered by free cash flow. EBIT interest coverage above 3 times, caution at 1.9 times. This is the one yellow flag. Warning, EBITDA interest coverage, pass at 5.2 times. Pricing power above inflation, pass. Confirmed across all geographies. Dividend CAGR above 5%. Strong pass at 13% CAGR since FI 2019. Consistent dividend history of 5+ years, pass. Unbroken dividends since FI 2016. Margin of safety at least 30%. Partial at 14.7% at 2 Singapore dollars and 84 cents. Warning, overall verdict, pass monitor. This is a quality business with one structural financial flag, the EBIT interest coverage and insufficient margin of safety at the current price. Patient investors should watch for 2 Singapore dollars and 50 cents. If I was sitting across from Dr. Kelvin Lowe, the group CEO, these are the 5 questions I would ask, ordered by information value. Question 1. Turkey. At what point does IHH consider divesting Acibadem or ring-fencing entirely? And what is the FX hedging policy for EBITDA? The answer to this tells me everything about capital allocation discipline. Question 2. India organic versus acquisition growth. You spent billions on Fortis and Continental. Now what? Are you done buying? Or is there more M&A to come? And what is the specific EBITDA margin target for Fortis by FI 2028? Question 3. Debt trajectory. EBIT coverage is tight. What is the board's target net debt to EBITDA for FI 2027? And what levers, asset disposals, FCF rights issue, get you there? Question 4. Physician retention. Competition for top surgeons in Singapore is intensifying. How is IHH specifically protecting its consultant relationships against Raffles Medical, Thomson, and Healthway? Question 5. AI and digital. Where specifically is IHH deploying AI? What has been the measurable productivity impact so far? And what is the 5-year digital CapEx budget? This question tells you whether management is being serious or just talking. So, the verdict. IHH Healthcare Berhad, Asia's largest private hospital operator. 6 moats, 13% dividend growth, a world-class brand portfolio, and a structurally irreplaceable position in Asia's healthcare supply chain. Our blended fair value is 3 Singapore dollars and 31 cents. Current price 2 Singapore dollars and 84 cents. That a 14.7% margin of safety, which is real, meaningful upside, but below the 30% threshold the JC framework requires for a full position. Past monitor it is. The optimal entry level is 2 Singapore dollars and 50 cents. At that price, margin of safety clears 30%, and the framework gives a green light for a full position. In the bull case, if India's Fortis margins accelerate and Turkey stabilizes, this stock sees 4 Singapore dollars or beyond within 3 to 4 years. In the bear case, if Turkey spirals further and debt costs rise, you're looking at 2 Singapore dollars and 20 cents on the downside. For the income investor, this is a 13% CAGR dividend compounder in one of the world's most structurally protected industries. Patient capital will be rewarded. For traders looking for a quick pop, look elsewhere. This is a business you own for 5 to 10 years. That's a full IHH deep dive. 6 annual reports. For geographies, 15 slides. 1 verdict. Past monitor. If you found this useful, hit the like button. It helps more investors find this kind of research. Subscribe if you want the next deep dive in the JC Fund Portfolio Series. And drop a comment below. I want to know, would you buy IHH at 2 Singapore dollars and 84 cents, or are you waiting for 2 Singapore dollars and 50 cents? This is not investment advice. Do your own due diligence. But this is exactly how we think about quality businesses at the JC Fund. See you in the next one.